Welcome to Inside the Deal. I'm Suzanne Stevens. My guest today is Bob Profusek, a global head of M&A for the law firm Jones Day. And Bob, we're here to talk about the new age of private equity. That's the topic of an article that you penned for a recent issue of The Deal. And PE firms are out there raising money. We know that. And you believe we're going to see them investing in a different kind of deal in some maybe surprising sectors. What are those?
Well, historically, private equity firms have invested in consumer-related businesses, old economy industries, and all the rest of it. But we have tremendous needs for equity capital in terms of infrastructure, energy, environmental, the confluence of energy and environmental, and all the rest of it. And there's really no better place for that capital to be brought to bear than the PE community.
And so you're talking about big capital-intensive projects like infrastructure and alternative energy.
Oh, that's right. And I've always said, and it's probably a little bit trite, but there's not very many pages between the front page and the business section front page. And the name of the game these days is infrastructure, environmental, and energy. And there have been a number of deals already, and there are a lot more in the works, where huge amounts of equity capital, unleveraged, are being put into this space. It's different by quantity than venture capital was in the IT revolution, but conceptually it's the same.
But much higher dollar amounts.
Oh, huge amounts of capital. If you look at the Dominion Resources deal, where Riverstone wrote a $500 million check in $1 billion venture with a strategic, Dominion Resources, to a greenfield and ethanol plant up in Alberta. That's the kind of thing you're going to see more and more of when you get Boone Pickens out in front of the wind movement, for example. There's no question that capital is going to flow into these sources. And, as you said, it's big ticket equity. The so-called credit crisis really irrelevant to this phenomenon.
Well, in alternative energy, certainly, there's a lot of risk there, and we don't really know where that market is going. Are private equity firms, and I guess more importantly, are their investors prepared for these riskier, what could be perceived as riskier investments and perhaps more modest returns?
Well, the return requirements in private equity have dropped enormously in the last 25 years. It used to be, to track capital, you had to promise 30 to 40% returns. Those days are over. Mid-teens do it just fine, and that's because private equity has grown up. It is sophisticated institutional money that really wants to make sure it can beat the public capital markets. If you look at the S&P over its life, that's an 8% return market. If you can do twice that, mid-teens, you're doing great. And so while certainly the private equity community would prefer to beat 15%, that's sort of the necessary target in order to keep raising capital and be successful. And in these days, that's why, despite the fact that the capital markets today, the public markets are down, and the debt markets are, frankly, more or less dead for deal finance, private equity is still raising gobs of money. $30 billion this year alone for TPG, focused mostly on financial assets, but there's plenty of money around.
Well, in private equity, as with venture capital as well, it's always been about where you place your bets.
That's right. But as you said a minute ago, these are big bets, $500 million on ethanol. Well, wait a minute, there's too much ethanol in the world right now. I mean, one of the things about this whole e-tech sort of investment phenomenon is that people are looking on a much bigger basis. And when you look at the macro factors, globalization, the emergence of the middle class in India, China, and all the rest of it, that's what's fueling this demand. So it isn't a function of temporary blips in the West Texas Intermediate price. This is long-term patient money. Particularly, and the risk is lower when private equity teams up with corporate sponsors.
With a strategic partner, sure.
Another similar deal was, I think it was First Reserve or Riverstone, I can't recall, teaming up with AES, another $500 million equity check. Again, don't have to go and get your bank to support this. This is an equity decision. So the E really is being put back into PE, but it's also being put into the sort of e-tech world.
Well, now these investments, though, require a different set of perhaps executive and operational talent to manage these investments going forward. Is private equity prepared for that?
Yes, it's definitely preparing, and that's another way in which the PE firms have grown up. It's not a bunch of newly minted MBAs running around leveraging up a balance sheet and hoping that everything works okay and getting great returns because they have so little equity in it. The private equity firms are hiring very sophisticated, experienced managers, putting them to work on their investments, people who know what they're doing, got industry dirt under their fingernails, so to speak, and are able to help them because it's not financial engineering anymore. This is much bigger picture, macro kinds of stuff. And if you look at the bellwether firms like KKR, Blackstone, and the rest of it, when you look at their rosters, they've got lots and lots of industry people today.
Bob Profusek, thanks for coming in and talking about this. It'll be interesting to see where this goes forward.
You're very welcome. Thank you.
I'm Suzanne Stevens. Thanks for watching Inside the Deal. If you have suggestions of topics we should cover, you can put a comment below or send us an email at reporters@thedeal.com. Thanks for watching.